This video is all about corporate treasuries, and we're going to define them based on their three goals and explain what they do based on the seven functions they execute to reach those goals. As a quick note, a corporate treasury is distinct and different from a government treasury, although they do perform a lot of similar functions. Essentially, a government treasury just has some additional functions or tasks, which include writing policy or making economic suggestions to the government, which could be the president or the prime minister, depending on the country. Here we've got sort of a visualization to explain the goals and functions. As for our goals, we have short-term liquidity and cash flow management, mid-term fundraising as needed, and long-term capital market income. On the function side, we have account payable management, working capital management, fundraising, cash forecasting, payout strategies, financial risk management, capital structure, and cost of capital. So these are a lot of technical terms, and I'm going to briefly explain what each of these items are, but it is a bit of a complex topic, so I've also written a detailed article that you can find at analystanswers.com. I'll put a link in the description. So on the goals side, when we talk about short-term liquidity and cash flow management, what this simply means is that one of the primary goals of the corporate treasury department is to make sure that in the short term, the company has enough cash to function. So liquidity is, as a concept, is just the idea that at any given time, if a company needs to pay an obligation today or tomorrow, which could be a trade obligation, like an account payable, or a bigger obligation such as a payout to shareholders or to a creditor such as a bank, that they have the cash to do so. So one of their primary goals is, to kind of help the C level or the C-suite manage the cash to make sure there's enough in the bank account at all times. As a second step, midterm fundraising as needed. While they manage cash in the short term, they also need to be able to evaluate techniques or options for raising funds to execute business strategic goals, let's say 6 months to a year down the road. That'd be the midterm. And then the long term, what they do is with this excess cash that they have developed or they strategically generate from operations that they invested into capital markets, so which could just be stocks and bonds, in order to generate some additional income for the company on the capital markets. Now, the way that they perform all these three goals is with the seven functions. So the first one is accounts payable management, which essentially means that accounts payable are the obligations that a company has to pay at any time. So when a company receives an invoice, someone says, "Oh, you owe us money," this could be a bank or I guess just a trade partner. They say, all right, well, we're going to wait maybe a period of 25 days or 30 days or whatever the contract allows to pay this. That way we can keep cash in the bank account longer. So this kind of falls or flows into the second point, which is working capital management. Working capital essentially consists of all of the current assets and current liabilities, which are items due within 1 year. So I guess at a maximum of 1 year or less. This includes accounts payable, number one, but it also includes accounts receivable. So a company might try to insist that their trade partners pay them more quickly. So their accounts receivable will go down. That way they have more cash that they can use for fundraising or even investing in long-term capital market income securities. The third function is fundraising, which is sort of a direct derivative of goal number two. So when a company has a strategic objective, they need to often invest a lot of cash up front. And the CEO and the CFO are responsible for deciding on those activities or strategic initiatives, but the Treasury Department is responsible for finding the cash to execute them, and then also making suggestions, right? The Treasury Department might say, well, we don't have enough money, so we need to wait on the strategic decision until we get some, or maybe we need to adapt the working capital management policy, or a number of different things. But the Treasury Department has sort of a dual role. It's to make suggestions and then to execute. Number four is cash forecasting. This is arguably the most critical function of the Treasury Department because Cash forecasting is essentially a schedule. It's a timeline with, you can think of it as a positive and negative bar chart, where positive bars are cash inflow and negative bars are cash outflow. So essentially, what the Treasury Department is doing with cash forecasting is just predicting based on the most likely scenarios, often 2 to 3 months into the future, how much money the company will have based on a schedule and at what point it will have it in time. Number five is payout strategies, and these are essentially this is nothing more than dividends. So whether the company is a public company and it pays out dividends to a large number of shareholders, or it's a private company and there's really just a few, one or two, or maybe even 10. In this case, they need to strategically design their cash flow so that they have enough to pay out at the end of the year to those shareholders. Number six is financial risk management, which is in most cases a hedging policy against foreign currency exchange rates. This is sort of a complicated topic that I've broken down in the article in more detail, but in a sentence, it just means that they place money in different financial regions, such as the European Union, which is based on the euro, and the United States, which is based on the US dollar, so that when exchange rates change, they don't lose money. It's more of a hedging principle, which means that it's supposed to help them prevent loss rather than a gaining principle, although in many cases, good treasury departments can make money doing this. The seventh function is capital structure and the cost of capital. And this is sort of the balance sheet aspect of the Treasury Department, the major balance sheet aspect of the Treasury Department, which is capital structure is essentially nothing more than the funding of assets. And we have two ways to fund assets. One is with liabilities and the other one is with equity. Equity is, in most cases, contributions directly from the shareholder, so it's not a result of creditors such as banks or operations. It's just what do the shareholders bring to the table? How much money can they invest directly into the company to fund, for example, those strategic decisions? So it's essentially if you have 100% in assets, what is the proportional percent of equity and debt or liabilities? It could be 50-50, it could be 70-30, it could be 80-20. It just depends on the industry and the business and the strategic position of the CEO and CFO. The cost of capital is another quite complex topic, but the principle of cost of capital is how much does it cost to make that equity or to make that debt, or to get that equity and get that debt. In other words, debt or a loan, the cost of capital for that would be the interest rate that you have to pay every month or every year, whatever the period is, in order to have that money. So that's the cost that you have to pay to make to generate the debt. And then the equity side is a little bit easier in principle, more difficult to calculate. It's just the idea of how much money does the company need to pay to its shareholders in order for them to feel incentivized to give the company money. Those are your 3 goals and your 7 functions. I realize that it's sort of a complicated topic, as I've said a few times, so if you'd like, you can go to analystanswers.com. I'll also put a link in the description to the article that directly discusses this topic. Thanks for watching.